Hello everyone and welcome to the derivative snippets with Shilpa. In some of the few videos that we would be coming up with, we would deconstruct derivatives and then understand in our own simple language. So let's get moving. In this video, we would learn what are derivatives, why do we use them, what are future and option contracts, and few more terminologies that we use daily in this market. So what are derivatives? Derivatives are financial instruments whose value is derived from its underlying spot price. Underlying here would mean equities, currencies, commodities, etc. Then coming like who are the participants in this market? There are basically three kinds of participants in derivatives. They are hedgers, they are speculators, and they are the third kind is arbitrage. Now, we also have four types of derivative contracts mainly. They are futures, they are forwards, they are swaps, and they are options. But we emphasize only on futures and options because they are the only standardized contracts and are traded on a centralized platform like NSE. Let me explain all of this in a very short example. Suppose there's a farmer who wishes to enter a contract and wants to sell his harvest in a future date, eliminating all the risk that he assumes would come up with the price fluctuations. Then he would find a buyer who would be actually willingly taking the risk to buy that harvest for a future date, but his value would be derived from the current and the spot price of today. Here the underlying is the harvest, and here we see that the farmer is the hedger who is eliminating the risk of his harvest, assuming that there would be a price fluctuation in the future, whereas the buyer is the speculator here who assumes that the price fluctuation wouldn't matter and he is hoping that his harvest, whatever he is buying today, would reap him benefits. So this is what we learn. So there is a hedger, there is a speculator, and the contract that they both enter into are known as future contracts. In derivatives, this is what actually happens. It's quite simple, right? So now what are future contracts? Future contracts are nothing but an agreement between two parties who agree to buy or sell the underlying at a particular date and a particular price. And option contracts, they are the contract that gives the buyer the right to buy but not an obligation to sell the same at a stipulated date or a time. In an option contract, the buyer pays the premium and has the right over the asset, whereas the writer of the options, they receive the premium and they are obliged to exercise their asset whenever the buyer asks for so. So coming to the why do we trade in derivatives? Derivatives comes in a basket of benefits. First it gives you leverage to participate in a market with a very limited investment. Within only 20% to 40% of the investment, any trader can participate in the market. And second would be hedging. Hedging is nothing but an insurance for your investment, for the trader's investment and for the stocks, which is possible only with derivatives, like we understood with that example of the farmer who's been the hedger there. And as we understand that since the margin utilization is required less here in derivatives, there is more participation in the market. More participation means more liquidity in the market, which in turn makes the market very attractive for traders. Last but not the least, to understand in derivatives, there is a huge study and loads of data crunching which helps any trader, any layman even, to understand the sentiment of the market and thus helps in judging the direction of the market, which actually in turn helps any trader to optimize their investments and make more profits. We'll actually explain everything in a short example again. Let's assume that you are in a horse race and you want to bet on a horse. So what you do is you bet an amount, but you don't actually buy the horse. You bet an amount on a particular horse and you own that horse for that particular race only. It is similarly in derivatives, where you, by paying only a margin of maybe 20% to 40%, you actually own that stock for a particular time, for a stipulated period of time. And that stipulated period of time actually expires on every Thursday of the month, which we term it as expiry in our derivatives language. Easy, right? like all contracts, even future contracts and option contracts, they expire. That is on the last Thursday of the month. Option contracts also comes with loads of benefits, because we even pay a even smaller amount there. We just pay a premium and we are free to participate in the entire market, and we own that asset till the expiry again. And the best part is that the loss what would be the maximum is capped, because it is only the premium that we pay is the maximum loss one would incur. So this makes option trading a very interesting tool for any trader. Option trading actually has a lot more into this, loads of strategies, which in coming videos we would learn the different kind of option calls, and what are the strategies involved in this. So for that, till that time, so that's it from me. Thank you.